Let's get more on the markets from Brett Ewing, Senior Financial Advisor and Chief Market Strategist at First Franklin Financial Services. Brett, thanks very much for joining us.
Thank you for having me.
What's your reaction here? We'll put up a one-year chart for Broadcom and for Oracle. Concerns seem to be centering on those two with their heavy spending. Broadcom, of course, has been a market darling.
Yes, I mean, I think we're continuing the theme here that, sell the news situation, and a little bit of the shine is coming off all of the AI trade here. And it's a massive, violent rotation into other areas of the market that we're paying attention to, and we believe will continue throughout 26.
And Oracle, in particular, took a major hit yesterday, and we did see fresh selling pressure today. There seems to be a concern that they may have bitten off too much more than they can chew. For example, racking up a debt load of more than $100 billion US.
Yeah, absolutely. I mean, transparency is coming through with all the AI ecosystems and the level of debt, the circular financing, all of that's floating to the surface. I think this is a positive for the whole AI infrastructure build out that we're seeing. This is a healthy correction within that. I think there are a lot of these companies, the overcrowding that we've seen as we went into October, that's very unhealthy and it's creating bad behavior with investors. And I think these companies need to grow into their potential earnings from AI down the road. I look at this as a positive for the entire ecosystem.
In the sense that some of the air is coming out?
Absolutely. It's a very unhealthy market as we entered into October. The breadth of the market was absolutely horrific. And since about a 4.7% correction in the S&P 500, what we've seen coming out of this correction is a very strong increase in the breadth of the market, and particular in small and mid-cap companies. And we believe that trend is intact throughout the rest of 26.
Yeah, it is interesting. The Russell 2000, as I'm sure you know, hit a record high yesterday, the benchmark of small companies.
Yes, absolutely. People don't talk about this enough, but since the big correction that we had in the market bottom on April 9th, the S&P 500 is underperforming the Russell 2000 by about 10 percentage points.
Wow.
It's a pretty significant differential.
I guess portfolio managers, well, it's a dilemma for them, isn't it? They don't want to miss out on this AI boom. It's been so strong. In the couple of weeks that's left in the trading year, what patterns do you think we'll see? Do you think portfolio managers will be tempted to lighten up on these AI-related names?
Yeah, I think they will underperform going into the end of the year. I really do. I think there's going to be profit taking. We're already seeing the rotation. It should be going into interest sensitive assets, small and mid cap companies. I think housing related stocks are going to outperform actually AI going into the end of the year and throughout 2026.
Why is that? Why do you think we'll see strength in housing?
Well, I think the market is truly underestimating how many rate cuts we're going to get. The market's pricing in maybe 2 rate cuts next year, possibly 3. I think we're going to get around 4 rate cuts in 2026. And I believe that the market's just underpricing how much rates are going to come down. Our prediction is that housing related stocks in the housing market, we've been in a pretty much a recession in housing here in America. And I believe that changes the second half of 26. I think the housing market loosens up and we start seeing existing home sales coming off of this 30-year low and skyrocket.
Maybe we could put up a 5-year chart for United Healthcare. I mean, without commenting necessarily on United Healthcare, it's had a horrible year. There are concerns about health insurer profits. But we've seen something of a bounce off the low in UNH, just as an example. Do you think healthcare looks like a decent bet? I mean, it's been an old reliable over the years.
Yes, healthcare, I think, is a sector that will also perform well in 2026. It started its move about halfway through this year, and we think it's going to probably gain some strength as we get into 2026.
And what about your great bank stocks in America, the JP Morgans and Bank of America? Lower interest rates tend to increase their profit margins.
Yeah, I think the yield curve can shift down as a whole. Like I said, the short end of the yield curve should come down, but we are also expecting the longer end of the yield curve to come down as well.
Oh.
Surprisingly, but we do believe it will do that. We're going to get a new Fed chair in, Bassett, of course, at the Treasury, and Trump. They all seem to have a vested interest in getting the 10-year Treasury down, and what tools they use to do that, we don't know yet, but we do believe that that is a very important subject because that is controlling a lot of interest-sensitive areas of the market, such as housing, which needs to be fixed here in the United States.
Thank you so much. I really appreciate it. Have a great weekend, Brett. Brett Ewing, Senior Financial Advisor and Chief Market Strategist at First Franklin Financial Services.